tell us about market risk.
Market risk is a collective term for the factors that might make asset prices move, because a trader can lose as well as make money when prices move. It's a risk. You will probably have heard commentators referring to market risk when talking about factors that make prices fall. This is because they are normally commentating on the general factors that impact long-only investments.
And what about when prices rise?
Well, because margin traders can go short as well, there is also risk that they will lose money when prices rise. Try to think of market risk as the factors that move prices across the whole market.
Okay, so these are risks that make market prices go up or down. Got it.
Yes, market risk is by far the most visible risk in trading. It's reflected in the flashing prices you see in the trading platform. Its impact is measured almost to the second by a trader's account statistics, because this is the type of risk that traders want when they trade. As traders, it's one of the risks that we talk about and we try to analyze the most.
Okay, I'm with you so far. What else do we need to know about market risk?
Well, market risk is also referred to as systematic risk. The two terms might be used interchangeably. Systematic risks are the factors that impact the prices of securities across the wider market.
So what would impact prices across the whole market?
There are many systematic risks, and some common examples are elections, economic announcements, inflation, interest rates, currency rates, changes to taxation, recession, and so on. These are by no means an exhaustive list. These and a great deal more can have a major impact on price in either direction across a wide range of financial instruments in a market. An important point to make is that if a trader trades indices, currencies, commodities, or government bonds, they are typically speculating on systematic risk. Unsystematic risks are those factors and events that only impact the price of individual securities, such as company shares.
So, I take it unsystematic risks are those that have less of an impact on the wider market.
Yes, spot on. But unsystematic risks can be just as significant, but even more from an individual security perspective, rather than a market-wide one. How they impact traders is largely down to the instruments traded.
Can you give us some examples of unsystematic risk?
Certainly, some examples for individual company shares might be the resignation of a CEO, a product recall, a new approved patent, a poor set of financial results, a good set of financial results, bankruptcy, and anything that impacts the price of that particular security and not those in the wider market. Again, this is not an exhaustive list.
Okay, so systematic risk affects the entire market and unsystematic risk affects individual securities.
Next up, I'm going to introduce something called volatility.
I've heard that term before when people talk about the market being volatile. It doesn't sound like a good thing.
Well, it's not as bad as it sounds. It's a bit complex, but market risk isn't just about the risk of prices moving. It's also about how quickly they move, which is known as volatility.
Oh, I see. That doesn't sound quite so bad.
Volatility is the rate at which a price changes. Some markets have prices that change very quickly, others less so. Let me show you on a chart. You'll be able to see what I mean. This is a security with a relatively low volatility. And if I overlay a security with a relatively high volatility, you should see, despite making broadly the same move over the course of the chart, the price changes more.
Yes, I can see that. It jags around a lot more. So which markets would you describe as volatile?
Well, for the time being, we won't go into a specific market. You just need to be aware of what volatility is at the moment.